Good afternoon, ladies and gentlemen. I'm Panos Kotseras from CRU, and it is my great pleasure to speak this morning at the Metal Pages Nickel, Cobalt and Molybdenum Conference and present to you our view on the cobalt market. First of all, I would like to say a few words about CRU. We are a privately owned company founded in the 1960s. Our aim is to support our clients with market analysis, management consultancy and events, concentrating on the mining, metals and fertilizers industries. Altogether, we cover 75 different commodities. In the way this presentation is structured, we shall begin with refined demand. Then we will talk about refined supply, and we shall finish looking at the market balance and prices. We are starting with refined demand, which is based on a real consumption methodology. This slide shows a pie chart of refined cobalt consumption by end-use sector in 2011. Refined cobalt consumption amounted to 75,300 tons, an increase of 6.1% from the previous year. 58% of that volume was used by the chemical end-use sectors, the largest of which was the battery sector. The superalloy sector accounted for 18% of total refined cobalt consumption. In this category, the most important end use is rotating components for aircraft engines. Putting the chemical and superalloy sectors together, they jointly accounted for 3/4 of global refined demand, and they are both critically important for volume and growth. The remaining 25% of refined cobalt demand came from carbides and diamond tools, magnets, as well as steel applications. Moving on to the next slide, you can see a pie chart illustrating refined cobalt consumption shares by region in 2011. Not surprisingly, China accounted for 35% of refined cobalt demand. The largest contribution came from the domestic battery industry. In this particular end use, it is this particular end use that boosted China's share of cobalt consumption to the current level from under 10% in 2000. Looking at other regions at this pie chart, it is worth emphasizing that Western Europe and the USA maintain a relatively large share of global refined consumption. This is attributed to demand for superalloys from the regional aerospace industries. Given the strong long-term outlook for air traffic, we believe that this pattern will continue. The rest of Asia made 27% of refined cobalt demand in 2011, supported by a traditionally strong battery industry in Northeast Asia. What this stack diagram illustrates is the evolution of refined cobalt demand by end-use sector from 2008 to 2016. The percentage rates on top of the columns provide the year-on-year change in global refined demand. CRU predicts that refined cobalt demand will exceed the level of 100,000 tons by 2016. What is instantly noticed when looking at this chart is the growth, first of the chemical and second of the superalloy sectors. Once again, the driving forces behind this growth are batteries and aircraft engines. Another point I would like to highlight is the relatively modest decline that refined cobalt consumption experienced in 2009. Considering the shock the global economy encountered in 2009, a contraction of 3.2% can only be regarded as minor. In the same year, refined copper consumption fell by 5%, while that of primary aluminium by 8.3%. What we are attempting to do in this slide is to compare cobalt consumption growth against changes in the global total industrial production index. The chart is based on year-on-year percentage changes of the two series, and there are 2 points I would like to draw your attention to. First, there is a close relationship between annual changes in cobalt consumption and those of the general industrial production index. Second, cobalt consumption growth outperforms advances in total industrial activity, and this is attributed to above average performance of its largest end-use sectors, namely batteries and aircraft engines. If we were to compare copper against the general IP index, we would see that the two series would almost converge to each other. As a result, cobalt benefits from its heavy exposure to growing high-end industries. Regarding where we are in this presentation, we have finished with the refined demand section, and we are now turning to refined supply. In this chart, we are looking at a total refined cobalt supply, which consists of both chemical and metal forms. The columns show refined cobalt supply volumes along with year-on-year growth rates on top of them. Refined cobalt supply reached 79,400 tons in 2011, a 9.1% increase from the previous year. Even for market participants that have been in this industry for several years, mapping the supply side of cobalt is a significant challenge. Cobalt is primarily a byproduct of nickel and copper mining, and therefore, thinking of the value chain, the supply side does not respond only to signals from the downstream sectors. Supported by tight fundamentals, the outlook for nickel and copper prices is strong, and therefore cobalt supply as a byproduct is projected to be robust. As you can see in the chart, cobalt supply grew aggressively in 2010, and that was due to consecutive startups at mines in the Democratic Republic of Congo, which boosted feed availability. The strong growth we predict from 2012 to the end of the forecast period is based on DRC mines that ramp up to nameplate capacity and high-pressure acid leach operations that start commercial production. Moving on, it would be interesting to talk about Chinese cobalt feed imports. CRU estimates that China produced 33,500 tons of refined cobalt in 2011. That makes China the largest refined cobalt producer in the world, with a share of 42%. This slide shows Chinese imports of ores and concentrates expressed in cobalt-contained terms. According to official statistics, 97% of Chinese imports originated from Africa. As you can see in the diagram on the left, Chinese imports of ores and concentrates in 2011 totaled 21,000 tons on a cobalt-contained basis. Due to the market slowdown in the second half of the year, the figure was marginally down from 2010. In this slide, we conduct a similar analysis. However, we are now looking at imports of intermediate products. Again, the volumes we refer to are expressed in cobalt-contained terms. In 2011, Chinese imports of intermediate products amounted to 17,000 tons on a cobalt-contained basis. This represents a 6.3% contraction from the previous year. Over the last few years, there has been an aggressive increase in Chinese intermediate products imports. In 2011, and despite the year-on-year decline, Chinese imports of intermediate products tripled from 2008. On the other hand, imports of ores and concentrate registered a 37% increase over the same period. Considering that domestic refined production rose by 75%, from 2008 to 2011, we believe that intermediate imports increasingly replace ores and concentrates as cobalt feed for refined production. This slide consolidates the findings of the previous two charts by analyzing the discrepancy between imported cobalt feed and domestic refined cobalt production in China. What we are doing here is to estimate apparent inventories of ores, concentrates, and intermediate products on a cumulative basis between 2008 to 2011. This methodology suggests that apparent inventories in 2011 amounted to just under 20,000 tons on a cobalt-contained basis. For the size of the cobalt industry, this is a large number, as it translates to approximately 24% of global refined cobalt production. This increase in apparent inventories, along with the current slowdown and the refined market surplus that we will discuss in a minute, put significant pressure to the cobalt market. Looking at the structure of the presentation, so far we have covered refined demand and supply, and we are now moving on to the market balance and price section. When we put the demand and supply numbers together, we generate the market balance, as you can see in the current slide, which covers the period from 2008 to 2016 on a refined cobalt basis. The noticeable change in the balance in 2010 is attributed to the aggressive supply growth, which outperformed demand. That marked the beginning of a period of surpluses in the cobalt market, which are expected to last throughout the forecast period. As we discussed earlier in this presentation, cobalt demand growth is healthy and comfortably outperforms the average growth rate of global industrial production. However, cobalt supply does not respond to cobalt demand needs only, and therefore this leads to considerable imbalances. If cobalt were not a byproduct, then we would expect that demand and supply dynamics would tend to bring the market to equilibrium. Supply would have to decline and match demand via the pricing mechanism. Turning to the next slide, we are looking at historic prices on a monthly basis from the beginning of 2008 to March 2012. Benchmark low-grade cobalt prices were flirting with the $50 per pound level in early 2008. In that year, the refined market exhibited a deficit of 7,000 tons. Moving on, the impact of the global financial crisis resulted in a plunge in cobalt prices, with low-grade material trading below $12 per pound in late 2008. Tight fundamentals and hopes of an industrial revival generated a rebound in prices in 2009, similar to many industrial metals. As in early 2010, low-grade cobalt reached a high of almost $22 per pound. After that, and excluding some occasional rallies, cobalt prices have been declining, mainly affected by weak fundamentals. On top of ongoing oversupply concerns, the cobalt market has been challenged since the summer of 2011 by the fact that demand has not been as strong as earlier anticipated due to the overall economic slowdown and downside risks. Within our price analysis, it would be interesting to illustrate a comparison between month-on-month changes in free market low-grade prices against those of LME cash prices. The chart provides a comparison from June 2010 to February 2012, featuring month-on-month percentage changes. What we wish to show here is that in the beginning of the period, changes in LME cobalt prices were not fully reflecting market dynamics. Therefore, at that time, LME prices were not as responsive as free market prices. However, as you can see in the last 6 months, month-on-month percentage changes in LME prices have been increasingly closer to those of free market prices. As the LME cobalt contract becomes more liquid, LME prices are expected to reflect better the dynamics in the cobalt market. Even though there are econometric methods that can test the degree of convergence as well as causal direction between the two prices, more time is required to reach solid conclusions as the LME contract is still young. This chart provides our cobalt price forecast on an annual basis to 2016. The forecast takes into consideration the current level of cobalt prices and the annual market balance to 2016. Benchmark low-grade prices averaged $16.4 per pound in 2011, a 12% decline from the previous year. For the year to 9th of March 2012, prices averaged $14.6 per pound after a short-lived rally seen early in January. We forecast that prices for full year 2012 will average $13.5 per pound due to the increasing surplus in the market. We project that prices will reach a bottom of $12.5 per pound in 2013 and 2014, as the market surplus is anticipated to remain persistently high. Prices are predicted to be supported in 2015 and 2016, as the surplus in the cobalt market will gradually fall. We believe that low-grade material will trade at $14.5 per pound by the end of the forecast period. I would like to close this presentation by summarizing the key points we discussed today. First, from a demand perspective, the cobalt market is anticipated to be strong. Despite the slowdown in the global economy, cobalt consumption benefits from above-average performance of its largest end-use sectors, batteries and the aerospace industry. Second, supply growth is expected to outperform demand. As cobalt is a byproduct, supply is not only a function of cobalt demand. Third, looking at Chinese imports of cobalt feed and domestic refined production, we believe that there is a noticeable accumulation of ores, concentrates, and intermediate product inventories in China. Fourth, the bottom line is that the cobalt market has and is expected to exhibit an increasing surplus. Market participants are aware of this situation, and that makes their decision-making cautious. Fifth, cobalt prices in the short and medium term are projected to remain below the $15 per pound level. This brings us to the end of this presentation on the outlook for cobalt. I hope you found it informative. Thank you very much for your attention.
Many thanks, Panos. Do we have some questions? I know lunch is beckoning, but I'm going to ask one anyway. Panos, when cobalt was at $40 a pound, many of the battery producers were making a lot of noises about substituting cobalt or reducing cobalt. And with cobalt's reliance on the battery sector as a consuming sector, do you see it vulnerable to substitution or technology change in the future?
As far as the battery sector is concerned, this is always an issue because it is very much a function of technology, and technology changes from one moment to the next, responding to prices, responding to new trends. So yes, in this case, it is always a concern.
Mm-hmm.